for those of you guys don't know your story, maybe you can chat a little bit about that. But kind of mobile home investing has been your bread and butter. And then since then, you've branched off to other things. And I do want to talk about that. But let's talk about how you started and where it's evolved to.
Started syndicating mobile home parks. I guess it's going on about 6 years now. That we've actually been pulling capital from the outside for multiple different mobile home parks funds that we've had now. And aside from that, we've been buying other asset classes as well, parking lots. And as you mentioned, build for rent's kind of our newest initiative.
It's very different now. Now it's like, you're basically, you're investing against Wall Street, right?
That's it. Yeah, that's it. And I think the challenge about investing against Wall Street is, whereas most of our investors are, retail investors. And so our blended cost of capital is significantly higher than that of most of these institutions. And so, they don't necessarily need to have as much of a yield. And again, just going back to their cost of capital is much less than ours overall. And so, whereas I might find a challenge with, making a 4 cap work, bidding against one of these big groups, not just necessarily that they can pay more for that asset, but their, I don't know the right way to put it, but their capital potentially much more accessible, and they can also probably get a little bit more aggressive than a typical buyer, i.e. us or other groups like us on the due diligence period. They're willing to take slightly more risk in order just to get that asset added to their portfolio. And so they're really trying to buy efficiencies and scale, and they're willing to, overlook a few key areas. Again, where I might need 40 days due diligence or maybe even 30 to push things quickly, they might be able to, say, well, we'll do it in 25, but also we're going to put up $500,000 hard from day one.
Where do you see things? Because I just got back from a conference, and we had a deal in escrow that we let go last week, 310 units, $100 million deal. And our cost of debt went up while in escrow. We had the thing, we were fully packed. We did due diligence. We did roof inspections. We walked every unit. We spent some time on it. And then the debt markets adjusted, as you know. And so we had to let it go because our cash flow wasn't there.
What ultimately was that seller's mindset? Because my guess is that you didn't. Well, you tell us. Did you actually drop the deal, or did you go back and attempt a retrade, which we don't like to do, but no one has control over what just occurred with the debt markets.
That's a fair question. I've been asked that. Okay, so I'll give you the whole scenario. Well, okay, broker pitches seller, hey, I think your deal's worth $100 million based on the activity at the time. So let's call that first quarter. Seller puts the deal, and they got a whisper, as you know, whatever that means, right? The whisper price, and it is what it is. So
Can you explain what a whisper price is?
A whisper means that the broker and the seller know the number.
Okay.
But the package goes out unpriced.
Okay.
So the in the multifamily space, and this has been going on for years, so we're very used to getting a deal that's unpriced. In other words, there is no listing price.
Like, show me your best offer, basically.
Essentially, you're right. And so then that went to thousands of people, hundreds of tours, lots of conversations, 30 plus offers, 2 rounds of best and finals. So we get the thing into escrow. Now, keep in mind, this is in our backyard. So this is a property I've been to. This is an incredible piece of land, incredible property. It's built in the 90s. It's dated. It's an $800 a month value add. So from my standpoint, I'm like, this is awesome. $800 per unit value add times 300 plus. It's a home run. If we can buy it correctly, right? So we get it into escrow. Ross and I put $1 million up. Refundable. That's the key. And I put refundable up because I'm like, the Fed is going to go, they're going to, they have a meeting in June. And I said, I do not want to be behind whatever, they had just raised rates, as you know, in May, I think it was. Mm-hmm. And I said, I don't know what's going to happen. I don't know, because they meet in June and July, and I don't want to be in escrow while we're messing around and trying to figure out our debt. So
with hard money.
So we go into due diligence, and the thing checks out, your normal stuff. So the seller's been running it pretty well. They've been spending money on it. There's a few things here and there, but generally it's pretty clean. We walk all the units, and the NOI is pretty close to what we thought it was, which is income minus debt. So now we're all locked and loaded. And of course, the last thing that has to be done is the debt quote, right? Mm-hmm. So now we're getting debt quotes, and our loan to value is going down, right? Because the capital markets. So the lenders are saying we're not going to lend you as much because of the risks that they're seeing. And then the prices, for the debt are, I think that we originally underwrote it, 2 months prior to that, and they call it the mid fours, for our debt. And I think that we're up in the 6 range. So now we're looking at a point, to point and a half on a 60 to $70 million loan, which is a lot of money, right? You're talking about $1 million in an additional loan cost, right? So now you got to look at that. Now everything's checked out at this point, and it's a heck of a value add. But the problem is, from my standpoint, Kev, I was like, well, now the cash flow is so tight because the cost of the mortgage payment went up so much. So my cash flow is way down, which means my return's way down, which means that I can't pay as much for the project. So all that's going on, obviously, and during due diligence, and we're struggling to figure out how do we keep this deal because it's a great deal. And so we extend due diligence for 14 days and say, listen, our debt quotes are coming in very high, our loan to value is very low, and we need more time. So they give us a little more time. And we just couldn't make it work. So we went back to the seller or the broker and said, listen, this is gonna, we don't want to insult you, but with the new price of debt, we think this thing's going to be worth probably in the high 80s for the same math to work.
Instead of 100. So basically
a
10% haircut.
Does that make sense?
Yeah.
And of course the seller, we don't want to piss off the seller, and we have a great relationship with the broker, but the fact is that the debt markets changed a lot while we were in escrow, and so luckily we weren't hard on the money.
The question I think a lot of people have, which I think all of us here on this call have, is talking about doing the typical value add business plan where you get a bridge and then you look to execute your business plan, get the rents up, get the NOI up, and then put perm debt in place if you intend that you'll hold that property. Is how do you underwrite it to what does that permanent debt look like? I mean, what number do you pick?
That's it.
Right now, I feel like we're just pulling it out of the air. Anyone that's buying something on a value add plan that's got to get a couple years bridge, you literally are just pulling a number out of the hat. I mean, it's not like 10 basis points or 20 basis points. It's like the variables are 100 basis points this way or 100 basis points that way, which is a fairly significant difference when you're talking about multi-million-dollar loans. It's either the deal making sense or not making sense when it comes time to put perm debt in place.
Right. So for us, Kevin, I didn't feel comfortable putting my investors at risk for not knowing what the interest rate would be when I got to a permanent loan.
Yeah. No, that's.
And does that change the whole value add strategy moving forward?
Well, it's interesting because I think that if somebody bought a value add in the last couple of years and they're on these bridge loans, then they're faced with this new exit issue, this new permanent debt issue. And what could happen is everything that they've grown, the value that they've actually created, and I believe that a lot of them have, could be wiped out with this new permanent loan price.
Now, and you're saying that because if you bought something that was worth $60 million and now it's worth $80 million, you need to sell it for it to cash flow.
Potentially.
And then you'd have to sell it for less because of the new rates.
Maybe not less. You're probably way in the money, but I don't know about a cash out refi.
Got it.
Right? So it just depends because as you know, Kevin, the lender is going to solve to what's called a debt coverage ratio. So a debt coverage ratio means they take a look at your NOI at the time, which arguably has grown through a value add, and then they're going to put a debt coverage ratio on it, and they're going to back into their loan.
Got it. Because basically you need to make this payment at this new higher rate, which could wipe out the money that you've added to the deal.
Exactly right. Right. So you still might have the equity in there.
Right.
I
But
think the one saving grace might be, and it obviously it's market dependent. But just speaking to Phoenix is a phenomenal market. Speaking to pretty much any major market in Florida, Tampa, Orlando, Miami, Jacksonville is the really the double. If they bought the property 2 years ago, more than likely they didn't forecast double-digit rent increases at least for a couple of years, and so there could be some type of saving grace in there, to where that helps offset them missing the target on whatever that permanent debt rate or whatever that permanent debt's going to be at as far as interest rate. But it's going to be. I don't like that uneasiness. That is
you're 100% right. Yeah, the saving grace, if there is one, is that they had fairly significant rent growth. Obviously, I know your company, Capital Sunrise Investors, but what's the best way people can reach you, get a hold of you, find out more about what you're doing? Because I know you're doing parking lots and build to rent, and you got all kinds of stuff happening. So what's the best way people can reach you?
Yeah, absolutely. If you want to learn more about our company and the different initiatives that we have going on, you can go to investwithsunrise.com. And then me personally, you can find me on my website, kevinbupp.com. Then also, I'd love to, if you wouldn't mind, Ken and Danille, I'd love to give out a free copy of the book that you just mentioned. This launch, you can see it up here on my bookshelf if you're looking at the video.
Cash Flow Investor.
Yeah, it just came out about a month and a half ago. It's for sale right now on Amazon for $19.99. But if you go to kevinbupp.com/free book, you can grab a free copy of it there.